Okay. Okay, so first we have to understand or we have to know. So orang kata tak kenal maka tak cinta. Okay, you don't know so you don't fall in love. Okay, so let's look at what corporate borrowing. Okay, the corporate borrowing, right? So this corporate borrowing is a loan. It's a loan by the corporation. Yeah, so corporation borrow money into trust of borrowing. Okay, the first one is a private debt. Okay, so private debt is in the financial institution or a financial institution or only one or two parties involved. Meaning that a financial institution or you may also have this private placement where you actually involved in one party. Okay, so this is like a private debt. Okay, so for instance, one individual will be your party for borrowing, all right. So this is on the private debt. Okay, so private debt they don't have any issue. Okay, for instance, you have a debt with a financial institution. So what you do is that you just pay the interest like a normal loan. Okay, so what concern is that actually we are looking at the bond where it is issued to the public, and this is what we call it as a public debt. Okay, so why public debt? Because we can transfer the ownership. Okay, ownership, and therefore we also have a price for this. For bond we have a price. So in a way that we need to find the value for debt. Value for debt. In a way that okay, this is actually the value of that is actually the price. The price for one investor to invest, or investor to invest or purchase lah, trading meaning that purchase or selling. All right. So in this value, right, we are talking about the intrinsic value. Intrinsic value. Value. All right. So meaning that this is a right. It is a real value lah. We are talking about the real value or the intrinsic value, right, for the stock. Okay. What is intrinsic value compared to market price? Okay, so market price is actually market stated in the price stated in the market lah. This is the market price, okay. But this is intrinsic value is actually calculated based on the right information from the bond itself. Okay, so the coupon rate, yield to maturity, what else? Term, okay, term and whatnot. Okay, so these are actually the corporate borrowing. Okay, so financial institution, this is a financial institution where actually corporation borrowed money. So this is for working capital loan, right? Okay, so private debt. So I want you to read on that. Okay, so we go to the corporate, corporate borrowing. Okay, corporate bond. So corporate bond is security sold by the corporation, right? Security sold by the corporation that has promised future payment and maturity date. Meaning that if you purchase it today, right? And so for example, in 5 years time, 1, 2, 3, 4, and 5. Okay, so 1, 2, 3, 4, and 5. So if you purchase here, this is the price of the bond, right? And you're gonna have a maturity here, right? Maturity, where you are actually paying a par value for here or the face value of the bond. Okay, so what's here is actually the coupon payment. Okay, so you have all these coupon payment in between, right? Okay, so if the firm fails to make a promised interest and principal payment, then the bond trustee can classify the firm as insolvent and forced to bankruptcy. Okay, so let's see here. So bond has a claim on income and okay. So normally, right? Okay, income is actually with your operating, the operating profit, right? Or from net income of the company, right? Asset is whenever it is a liquidation. liquidation, meaning that when it goes bankruptcy, so the share will be liquidated, right? So what is the claim of the bond? Okay, so bond holder has a superior claim, right? Meaning that when, with regards to income and asset, so company has to pay to the bondholder first, then preferred stockholder, then only to the common stockholder. Okay, so common stockholder is a residual claimage. So residual claimage meaning that it will get the last distribution. Distribution. All right. So meaning that for bond, you are being paid a coupon payment. This is fixed. This is fixed. All right. So it is an obligation for the company or corporation to pay bond coupon payment. This is an obligation. But for preferred stock, what they receive a dividend. But however, this dividend is also fixed. So that's why preferred stock is actually they call it as a hybrid stock. Hybrid stock. Why? Because it has a similarity to the bond where the return is fixed, but okay, uh, they don't have the ownership. So dividend is similar to the common stockholder where they receive dividend, but the dividend is fixed. However, it does not have a similarity with the common stock, although it has equity, right? Because they don't have a voting right. Voting right. Okay. So let's look at the bond first. Okay, let's look at the bond first. Okay. So we know that I have already explained to you that bond, right? You have this market price or the price. You have a coupon payment, and you have this maturity. So meaning that, right? To find the value of preferred, to find the value of that here is actually by bringing all this cash flow, right? Bringing all this cash flow to the present value. Okay, bring all this cash flow to the present value, and this present value is actually the intrinsic value for that. Okay, let's see. Let's see. The features is one indenture claim. Okay, I want you to read on this one. All right. So what most important here is actually the claim of asset and income I have discussed with you. Okay. Par value, coupon payment, maturity. Okay, so this is actually maturity and repayment of principal. So it will pay the principal. The par value for bond is 100 or 1,000. Okay, in this example, for this calculation, I normally use the 10,000. 1,000, sorry, 1,000. Okay, so this bond also have a call provision or conversion, right? Why? Because it's that the coupon payment, right? Coupon payment is an obligation to the company. So therefore, it has a right to call the bond if it feels that it wanted to reduce the burden of paying the interest. Okay, for instance, now the market is 3% interest. All right, when they issued the bond is 5% interest or coupon payment. All right, so coupon payment, but now the interest is actually reducing to 3%, because our BLR is now 1.7 something. Okay, so in a way that if you want to lose or you want to discard this burden of paying 5%, so what you do is that you can call this bond, right, with a certain prices, then you don't have all this obligation anymore. All right, so subject that you have a fund to redeem this bond. Okay, so if you want to issue another one, you can issue at 3%. Okay, so the face of par value is actually the face of par value is actually a 100 or 1,000. All right. Okay, so the coupon rate is actually stated as the basic information of the bond. Normally, okay, it will be like if it stated that it's 8%, meaning that the coupon payment will be 1,000 times 0.08. So meaning that it is like, how much is that? 80%? 80 ringgit? Is it 80 ringgit?
80, yes.
One,
Yeah, 80 ringgit.
times 0.08. Okay, so 80 ringgit. Okay, so if the par value is 100, right? So times 0.08, so equal to 8 ringgit. Okay, so this is the reason why I normally use 1,000 lah, because at least you can see lah the value of the coupon payment there. Okay, so the maturity, this is actually the end. Okay, so this is a coupon rate, right? Par, normally we use this symbol par, right? And another one that we have is YTM. YTM is actually a discount rate. Okay, discount rate, or we can say that it is a a discount rate to what would you call it as, to discount all the cash flow of the bond. Okay, so YTM, why we call it YTM, because yield is a return to maturity, yield to maturity, right? It's actually return, return if you hold, assumption that you hold this bond until maturity. Okay, because, right, because if the end is 10 years, right, end is 10, you don't know when is the time you're going to sell this bond. Okay, so that's why we assume that we hold this bond until maturity, meaning that until maturity, the coupon payment will be issued to you, right? With this respect, meaning that the holding, right, the return for the bond, if you hold this until maturity, right? So what is the distribution here? Is that the proceed will be the purchase price, right? The maturity par minus selling price, right? Selling price, or is such a purchase price lah. Purchase price plus all distribution. Distribution. Income distribution. So this one is a coupon payment. This one is a proceed from the sales. Okay. So when we hold this to maturity, so the payment here, right? The payment here is par lah, because this one is 1,000 lah. Okay. So minus what is the purchase price that you are actually buying the bond from. Okay, meaning that if the price is 800 ringgit, so if it is a discount bond, so then you will have this return here plus all this, right? So we assume that the YTM for this actually the return when you hold this bond until maturity. Okay, all right. So there is a way of calculating this, right? Okay, so let's see. Okay, so this is the terminology for the bond, right? Okay, so I want you to read that. Okay, this is a current yield. Okay, so very simple current yield. Current yield is actually on the annual interest payment. So for instance, just now we calculated the okay, for instance here bond, we have bond with actually 8%. 8%. So the par value is 1,000. So coupon payment is 8% times 1,000 is 80. So the current market price is 700. Okay, so the current yield is 111.4. This is not yield to maturity. This is only current yield. Okay, meaning that the from the time the yield when you purchase at specific market price. Right. Okay. So um uh that's why here the definition here is that the current yield, right, on the bond refer to the ratio of annual interest payment to the bond current market price, meaning that at the current market price. So what is your current yield? So this is your current yield. Okay. All right. Okay. So I want you to read all this. Right. Bond rating. Okay. So we can have this bond rating. So it's actually bond rating is looking at the default risk. Default risk. Okay. When we are talking about default risk, so what is the risk that this company is having when or the investor will face? Is actually the payment of coupon. The coupon payment. All right. So the company might default. So default in paying the coupon payment. Okay, so this is what we call it as a default risk. So meaning that if the company is not having what you call it as the ability to pay for the coupon and whatnot. So the ranking will be falling. Okay, so the ranking will be from triple A to B. Okay, right. So this is actually in Malaysia. In Malaysia, we have two rating agency, RAM dengan Mark. Okay, so I will show you that. Okay, so this is actually rating agency from US. Okay, so but they use a same similar terminology. All right, so this one meaning that this is very good one. Right, normally this one MDS, Malaysian Government Security, or other government debt. Okay, the government bond. Okay, so this is D is actually at default. Okay, so high speculative. All right, the extremely speculative high meaning that this one is actually vulnerable, meaning that it is having a default risk. Right, so okay, so let's look at this rating. Right, so let me check first. uh, uh, I'm gonna stop sharing. Okay, I'm gonna show you the one. Yeah. Okay. And let's see. Okay. So um, okay. So this is one. This is all right. So this one and okay. So this is the okay. So this is Mark. So about rating guideline, okay, so you have a rating guide here, right? And rating product. Okay, let's see the rating guide here. Hmm. Okay, so this is a rating guide. So you can read the articles here at the bottom here, right? So okay. So we have all these table of contents, okay, rating, type of rating, Okay, so let's see, let's see the rating now. Hmm, okay. Issue credit. I want to see the summary of this. Okay, so this is the summary of it. So the credit rating here. Can you see this? Can you see the PDF here?
Yes, yes, madam.
Okay, now, all right, okay. So this is a very strong, right? So strong, triple A, still the same terminology, right? So highly speculative, C, all right? And okay, up to that, highly speculative, right? So this is on the Mark 3. So in Mark, they will put as Mark 1. So meaning that Mark 1 is actually on the strongest very strong and strong. This is in mark. Mark 2, right? Mark 2 state from strong until adequate here. Maknanya B, triple B plus. Okay, so meaning that if in Mark 2, meaning that this is short term lah. This is short term. Okay? So this is long term. All right. So if it is triple A, meaning that it is very good. Okay, so this is very good. So this one is a rating for short term. So what is short term? Short term debt meaning that like commercial paper, okay, negotiable certificate. No, not negotiable certificate of deposit. No, only short term. Only commercial paper. Only commercial paper. Right. So for long term, we use the triple A rating until C rating. Okay. So we have another one more. Where let's have a look here. Here is actually the fast B and M. So look at about, did you see this? RAM rating. Okay, so this is RAM rating. We have another also RAM rating, right? So in this RAM rating, right? So we also have all these. Okay, so credit rating. Okay, the table overview, rating definition and indicator. Okay, this is for RAM. Just now is for mark. Okay, so these are the indicator. All right. So for long term, can you see this? Okay, you can see this, right? Okay, so what is this? Triple A. The entity rated triple A has a superior capacity to meet its financial obligation. So did you see the words here, obligation? Meaning that it is an obligation by the company to pay coupon payment. Okay, so this is double A. Okay, so let's see the bottom one. Okay, so just now we have until up to C in mark. Okay, so for rating, RAM rating, right, we have up to D. And entity rated D is currently in default, meaning that the company is already in default. Is already in default. Or either all or substantial portion of its financial obligation, meaning that either it is in the coupon payment or in the maturity. Okay. So whether or not formally declared, right? Whether it has been declared or not, but it is actually in the history, the D rating may also reflect the filing of bankruptcy, meaning that it is approaching to bankruptcy. It is approaching to bankruptcy. So what you do if you have a D rating? So if you find a buyer who is going to buy this, so let off. If you find that you actually break even on the on that bond, so what you do is that you can sell off the bond. Okay, so it says that the D rating may also reflect the filing of bankruptcy and other action pertaining to the entity that jeopardize the payment of financial obligation. Jeopardize meaning that it has a potential or on the default. Okay, so the bottom here is actually on the short term. Okay, so you want this, so I can actually copy this to your chat box. All right. Okay, mark, just now, where is mark? Okay, so mark Malaysian rating. Here, Malaysian rating open in the new tab. All right. Malaysian rating agency. So mark, so for your reading, so you may look at this. All right. So let's continue with our lecture. Okay. So
this financial institute itself has a rating or not? Which have like mark
again?
This financial institute which doing the mark the rating like mark, it has a rating itself for itself.
I can't hear you. Hello?
Hello, can you hear me now?
Okay, never mind. Okay, so let's continue with the screen. Okay, so this is the mark. All right, so let's move on to the okay. Mm, okay, so this is the rating. Yeah, this is the rating. All right, so let's move on. Right, let's move on to the slide. Okay, so we will look into this matter later. All right, so these are the rating. Okay, so in valuing the corporate debt, okay, in valuing the corporate debt, so we have to have all those information in order for us to what do you call it, to discount all this cash flow. Okay, all right. So shall I have one example here, right? So I just put here, okay, and okay, then it, okay. So valuation of the corporate bond. Okay, valuation of corporate bond. Okay, so let's explain this in form of formula. Okay, so when we have all this cash flow, Sharon, are you speaking something because your name is here? Sharon? No, all right.
No idea. Sorry about it.
Okay, no problem. All right. Okay, so let's have a look here. All right. So if the bond is actually the par value of the bond is 1,000. Okay, we take 1,000 lah. Okay. So the coupon rate is 8%, right? And so let's have 5 years, right? 5 years. Okay. So with YTM, okay, YTM is we want to discount this at 10%, for instance. Okay, 10%, for instance, right? So let's calculate our coupon payment. Coupon payment, right? So our coupon payment is actually 1,000 times 0.08. So it is 80 ringgit, right? So 80 ringgit. So meaning that at this point, okay, so 1, 2, 3, 4, and 5. So meaning that this coupon payment will be paying here is 80 ringgit. Slowly, I showed you this slowly, slowly, because the most important thing is that I want you to understand on the calculation. 80, so 80, and is 5. So you're gonna have like 8 coupon payment, and towards the end, what you're gonna have is that you're gonna have a maturity. So after year end, you will year 5, you will have this 1,000 also payable to your account. So you want to see what is the present value, or you want to know what is the value for that. Or this also can be defined as price, as today at T0. Okay, so how you do this, right? How you do this? Because what you can do is that you can do 81 plus I power of 1. 81 plus I power of 2, 81 plus I power of 3, 81 plus I power of 4, and 81 plus I power of 5. And this one also 1 plus I power of 5. Okay, so what you do is that you bring all these to the present value. Okay, so since that we know this is equal distance and equal amount, equal distance and equal amount. So this comply with the, what do you call it, as a annuity. Yes, annuity, term of annuity. Term of Annuity.
Annuity.
This is annuity due or normal annuity?
This is normal annuity.
Normal annuity, exactly. So it is a normal annuity. All right. So what is the formula for normal annuity? Right. Present value of normal annuity, right, is a PMT, correct?
Yes.
1 minus 1 plus
Plus
I
I
power negative.
minus N divided by I.
Yes. Power by I.
I.
All right. All right. Okay. So this one stay the same lah, because this is we wanted to find the present value. So we add this 1000 1 plus I power of N. Okay. So this is annuity. We use PMT, but in bond or valuation of bond or debt, okay, we use this as a coupon payment. Coupon payment 1 minus 1 plus I power of negative N, right? This one divide by I plus par value. So this one 1000 is par, right? Par value. Okay.
Yes.
Par value 1 plus I power of N. So this is the formula for bond valuation. Okay. So let's see one. Okay. So let's see one how we do this, right? So just now we have okay. This is the one, right? Why suddenly it's gone?
Redo.
Huh?
From the top on the presentation.
Suddenly it's gone, huh?
Control Z.
Control?
Z.
Control V.
Undo.
Z.
Not. Okay, right. Okay, never mind. Okay. It's here. Oh, control V, yeah?
Z.
How to
Z. Z.
control?
Undo. Z. Z. Undo. Control Z.
Control Z, yeah?
Yes.
Control Z. Cannot lah. Cannot.
Control.
Okay.
Control Y.
Never mind. We don't control anymore. All right. So, this is actually the one that okay, so why suddenly it's gone? Okay, so never mind. Okay, so now we know that the value, the how to find the formula. The value for that is actually the coupon payment. Wow. Escape. When we discard, everything gone lah kan? Okay lah. Okay, we can do again. Okay. So now basically that you understand how to value the debt is actually by looking at it, the formula of coupon payment. Yeah. 1 minus 1 plus I power of negative N divided by I, right? Plus, right? Par value, right? 1 plus I power of N. Okay, why? Because just now we are looking at this 1, 2, 3, 4. So this is the, for instance, the par is 1000, right? So coupon rate is 8%. So coupon payment is 80. Okay, and is 5. Okay, so this is 5. So meaning that we have 1000 par here. And we also have 80, 80, 80, 80, and 80. All right. So now, what if, okay, so the present value or the value of debt or the price of debt, okay, what if YTM equal to 10%? Okay, so can you find what is the value for? Value for debt, right? So basically, we can put here 80. Okay, 1 minus 1 plus 0.1, the power of 5, and is 5, right? Divide by 0.1 plus power, what is the power value is 1000, right? 1 plus 0.1 power of 5. Okay, can you find what is the value here? $80, 1000, okay, 5 and 10. Okay, 9, 4.18. To get that, did you get that value?
Yes, doctor.
Okay, so we want to do again, right? We want to do again. So we replicate this. Okay, we replicate this. So the power value is 1000, right? The coupon rate is 8%. So coupon payment is 80, right? So N is 5, right? So YTM we will see. So what if the YTM is 10% just now? Okay, 10% you will get 9 to 4.18. Okay, I want you to try on YTM equal to, right? Equal to 7%, right? 7%. So how to find this? And YTM equal to 8%. Okay, so 7%. How to do this? 80, right? 1 minus 1.08. Sorry, 0.7. Okay, 0.7. I want you to try, because I'm going this very slow and steady because I want you to understand. 0.7, negative 5, okay, divide by 0.07 plus 1000. Why I repeat this? Because maybe some of you guys can catch the first calculation just now. So 0.1 point. Okay, I'm going very slow here, step by step. And 1.07, 1.07, right? Power of 5. Okay, so what is the value here? Okay, so if it is 8%, okay, 80, right? 81 minus 1, 1.08, right? Power of negative 5 divide by 0.08 plus 1000, right? 1.08 power of, power of 5. Okay. What will be the answer for the 7%? Okay.
1041.
104?
1041.
1041.00.
Oh, 00. Yes.
Okay. Right? Okay. So, what if it is 8%?
1000.
1000. Yeah, how you know it? Did you calculate or you look at the any formula?
No,
Because this example is actually not in the book, because I purposely use the example that which is not in the book. Okay, so did you notice here, right? Okay, why don't we just try 9%? YTM 9%.
Nine six one. 961.
961, 7.
No, 9. If we put 9, 961.
961.10,
Yes.
right? Okay. So did you notice here, right? So did you notice here when, right? This is the price, okay? The price or the value for that, right? So when it is 8% here, okay? So this is 1,000, right? So when it is 8% here, right? The price is at par. Yeah, the price is at par. Okay, but what if it is 9% here? The price is bottom here, 961, right? What if it is 7%? Sorry, this is 9. I say, what if it is 10%? Right?
924. 10%, 924.
924, eh? My this pen is a bit sensitive here. I need to change the setting. And okay, so this is 9%, right? If it is 10%, right? So the 10% will be 924. 924 here, right? So this is 961.10. All right. But okay, but when the interest rate is 7%, right? When interest rate is 7%, it goes up here to 1041.
41.
Did you notice the relationship here? It's actually the inverse relationship with interest rate, or we call this I, or we call it YTM. Okay, so it is an inverse relationship. So the higher the return, or the I or the YTM, the lower will be the, the value. Okay, so the issue here is that, okay, right, we want to find what is YTM. Okay, YTM, right? We want to know what is the YTM. Okay, so you know how to calculate this value, right? Okay, so let's move on how to find the YTM. Okay, so I want to copy this. Okay, all right, I want to copy this by making this duplicate the slide. Okay, and what I'm going to do is that move this up. Okay, just move this up, and then I want to see this. Okay, so again, what we do is that we want to look into this is one relationship, right? It is inversely related with the interest rate. Okay, so again, what we can do is that we can see the relationship when, okay, when change the end towards the end. Okay, so we use the same example here, right? Par value. Okay, par value is par value still the same 1,000, and it's not n YTM is 10%. Okay, and coupon rate is 8% still. Okay, YTM is 10. Okay, so we just play around with the n. Okay, let's find n equal to 5. So if n equal to 5, we already know that the price or the value is 9 to 4.18. Okay, let's have a look with n equal to 3, n equal to 10. Okay, so let's have a look at the price here. All right, so if it's n equal to 3, meaning that here 80, right? 81 minus 1.10 power of negative 3 divide by 0.10 plus 1000, 1.1 power of 3. Okay, so what is the value here? Right, so if 10, 80, okay, 1 minus 1.10, right, power of negative 10, okay, and divide by 0.10, okay, and this 1000, 1.1 power of 10. Okay, can we do this? Can we do the calculation here? Okay.
N3 is 950, correct?
Arik, I can't hear you.
It is 950. Is it 950?
9?
50, 50, 50.
950. Oh, okay, 950. Okay, wait, yeah. So 3. So 950, 26, right?
Correct.
Okay. So what if it is 10? 10 years.
877.
Huh?
877. 877.11.
877.11.
11.
Yeah. Yeah. So 80. All right. So 10 will be 10. 10 will be this one. Okay. 877.
0.11.
11. Okay, so 877.11. Okay, did you notice that, right? So did you notice that when it is approaching to maturity? Okay, so when it approach to maturity, right? So this is 10 years, right? So 10 years, 10 years. So if it is 10 years, so this is 3 years, right? 3 years is 950. 5 years is 5 years is
924.
924.
4.
And when it is, okay, when it is 10 years, so this is 3, 5, 10, it is 877.11.
These are like
Okay.
current installment, doctor. When you have
So
a shorter
meaning that
installment period.
meaning that when it approach to maturity, the value of the bond is approaching to par value. Okay, you may try 1 year. You may try n equal to 1. Okay, so the value is 981. If it is n equal to 1, the value is 9818, 981.8. Right, so it approaching to sorry, this is going up, right, 877, so this is 877 here, so it's going approach to par value. It's approaching par value. So okay, in a way that, right, the relationship for this n is that when it approach to maturity, the value of the bond is approaching par value or 1000. Okay, so that is another relationship. Okay, so any question for this? We're going to see the example for this. Okay, so any question for N? Okay, because I wanted to explain about the YTM just now. I want to explain about the YTM just now. Okay, so if no, okay, so I assume there is no question. So I want to explain on here. Okay, this part. This part. So I want to copy this again. Right, duplicate. All right. Okay, but what I'm going to do is that I'm going to, okay, this. Let's explain this, right? So let's compare coupon payment at coupon rate, and YTM. Okay, look at here. So this is 8%. Coupon rate is 8%. YTM is 8%. It is, where's the one, right? So it is par value. Okay, so it is 1,000. So we can say that it is par value, right? But what if the rate is 5%? This is 5%. So sorry, the rate here is 8%. Coupon rate still the same 8%. But YTM is, right, 5%. Meaning that, okay, the yield to maturity is greater than your coupon rate. Okay, so what is the price here? 9? 5%. 5%. Sorry. Again. 7%. 7%. Let's look at this one. 7%. 7%. So 10. 1041. So, okay. So this is at premium. At premium. Okay. So if YTM is lower than the YTM is lower than coupon rate. So this is am I doing wrongly here? Okay, 7%. This is not this is not the sign here. This is not the sign here. So 7%, this is 7%, right? 7%. Right, 7%. This is 7%. So meaning that coupon rate is greater than YTM. Greater than YTM. So you have a premium. You have a premium bond. Okay. So what if, right? What if you have here is 9%? So 9%. What is the value here? What is the value here?
961.
I really sorry for the inconvenient cost due to my pen here. Okay, I need to revisit my pen again because I just update the program just now. All right, so 9% is greater than 8. Yeah, okay. So this is at 961.10. This one, right?
Yes.
Correct? 9%. Okay, 961.10. Okay, so this we call this as a discount bond. Discount bond, right? Okay, so this is another relationship. This is another relationship. Okay, so the first one just now we look at this, the relationship between the price and the interest rate. Right, the first one is the price and the interest rate, and then the second one is that we're looking at the discount and premium bond. Right, and the third one we are actually looking at the duration where it is N. Okay, so what is the use of this one? Okay, for instance, we want to find YTM. We want to find the YTM. Okay, so we know that the price is given. Okay, for instance, if the price is 900. Okay, if the price is 900, okay, so if the price is 900, okay, the same bond with coupon rate is 8%, right? And it's 5, right? So we wanted to know what is the YTM. I wanted to know what is the YTM. Okay, so 900, okay, where is 900 will be?
The present value.
Huh?
This is the present value.
Yeah, the present value is 900. Meaning that, okay, it is, right? It is the YTM is greater or lower than coupon rate. Because we know that when YTM is equal to coupon rate, right? So the value is 1,000. Okay, right? So if we want to find the value of 900, okay, 900, okay, so it could be
9.5%.
9 and above, right? So meaning that it could be 9% and above. Okay, so now, okay, this is 900. Why don't I give you 970? Okay, so 970 is easy to calculate. All right, 970, right? So 970 will be in between 8 to 9.
9.
Correct? Correct? Correct?
Yes.
Okay, correct,
Yes.
right? Okay, because it is in between here. Okay, this is 907, 970 will be from 8, 970 will be from 8 to 9%. If I give you another price for 1,020, so the rate will be, so what is the rate here? The rate should be lower than 8%, correct?
Between 7 and 8.
Yes.
Right.
Yes, between 7 and 8, yes.
So meaning that is between 8 to
7 and 8.
7 and 8, meaning that 7 and 8. Okay, so this is the use of the use of this terminology or this relationship. Okay,
But
so
doctor,
let's find the
I have a
YTM.
question here.
Yes.
If I'm the company, what is my preferred option for YTM? Should I look for a greater one? Because I need at the end to have a
Corporation.
premium.
Corporation,
If I'm the company who is taking this money, I want now currently 900, correct?
I don't actually get your question here because your voice is a bit breaking here.
Yeah, that's the problem. But what I'm saying is, if I'm the company who's taking the money, borrowing the money,
Okay.
for me,
Yeah.
which one is the better option?
Okay.
The
So
high one, the high
the
UTM, or
higher your YTM will be, the higher will be your cost.
okay. So I would prefer always to have a lower one.
Your has to be a lower one. For
But the
corporation,
lower
your
one
has
will
to
give
be
us
a
at the
lower
end
one.
a high premium, right?
Yes.
And the future value will be higher than the others.
Pardon?
These higher, lower UTM will result in lower maybe monthly payment, but at the end, the premium value, the future value will be higher than the others, right?
Yeah, but you are actually looking at the another side, because this is the side of investor, okay, where you are looking at the high YTM because you're going to buy at a lower price. For investor, for corporation, all right, for corporation, right. So if you offer at a high price, right, so high price, meaning that, right, meaning that your cost of debt is lower because higher price, the lower the I. When I is lower, right, when I is lower, the price will be high. Okay, so meaning that here, right, you offer at a high rate, so meaning that you can you can offer only a limited number of bond lah. So when you offer a limited number of bond with that coupon of 8%, so meaning that company can reduce the cost of funding. The cost of funding. So we will learn that in the weighted average cost of capital. Weighted average cost of capital. So this actually cost of capital in corporation is a calculation of YTM. So that's why I want to explain to you on the calculation of YTM. Okay. So shall I continue?
Yeah, go ahead, please.
Okay. So I need to duplicate this. Now, this is one. Okay, this is and okay. I'm going to delete this. and paste. Okay. Now, how to find YTM? Okay, so we have two formula for YTM. Okay, the first one is that we are looking at YTM where we look at the coupon payment divided by M. M is either semi-annually or annually plus the par minus the market value divide by N times M, right? Divide by par plus market value divided by 2. Okay, so how we're going to find this, right? So what is the coupon payment? Coupon payment is 80. This formula is in your handout. This formula is in your handout. All right, so 80 plus, so what is M? Is 1 annually, right? Plus par 1,000 minus what is the market value? The market value is the price just now lah. So we are looking at 970. So this is 970. So we want to find the 970. So 970 divide by what is N? N is 5. N is 5 here. N is 5. N is 5 times 1 because it is annual. Divide by 1,000. Okay, plus 970 divided by 2. So can you get this answer here? Right? So what is the answer there?
It's 86 divided by 9,085.
80 plus
divided by
1,000 minus 970.
8.7%.
Huh?
This 8.7%.
Minus 970 by 5. Right, so this is 6, right? Plus 80, 66 divided by 1970 by 2. So it is 0.0873. So meaning that the yield to maturity is 8.73%. Okay, so this is using this formula. Okay, so another formula is that we use the interpolation. Okay, this interpolation, what is the formula for this YTM? Equal to, okay, I hope you get this answer,
Yeah,
okay.
I get the same answer.
You get the same answer. Okay, Tariq.
Yes.
So how about the rest? I didn't hear anything from the rest. I'm so worried here. Okay, either you are, I know you are not sleeping, but either you are understand or you don't understand how to calculate. Fahana?
Yes.
Okay, you get the same answer, Okay, so I'm going very slow because I know that we have a different level of understanding, okay? So I'm going very slow because I want you guys to understand how to find the YTM. So the second method is that, this is one method. The second method is actually by using interpolation. Okay, so this is where the picture come, this understanding come into the picture. Meaning that you have to know what is the price, what is the range of price, okay? So the YTM formula is, right, lower rate plus lower rate value minus desired rate value, okay, divide by lower rate value minus high rate value, right? This one is actually you times by higher rate minus lower rate. Okay, so let's do this one slowly. All right, so what is the lowest rate? So you know that it is between 8% to 9%. Correct? So this is your intuition just now, right? So what is 8%? What is the value of 8%? 8% is par 1,000. Okay, wait, yeah. 1,000. Okay, but 9%, 9% is 961, correct? 961.10. Okay, so the price for 970 is here. 970, right, is this range, meaning that it's between 8 and 9, correct? So what is the lower rate? Lower rate is 8%, 0.08 plus. So what is the lower rate value? Is 1,000. Okay, minus what is the desired rate value? So this is the rate. This is the amount, right? So 970 divided by lower rate value is 1,000 minus higher rate value is 961.10 divided by what is the interest differential here is 101. Okay, so what is your YTM here? YTM equal to, what is your YTM here? That's 970. Okay, by 1,000
8.77.
and 614. Okay, times 0.01. Okay, so plus 0.08. So it is 8.7.
8.77.
8.77. Okay, so 8.77%. So I got this 0.0
7712.
87712. Okay, so 8.770. So does this figure is correct, right? So it is in between the range. Okay, so did you notice that we have a different value for a different formula, right? Okay, so this formula is not an exact rate for the YTM. Okay, but this is the nearest rate, the nearest rate for this bond. Okay,
Which one? Formula number
yeah.
1 or 2?
Pardon?
Which formula you are saying the nearest one? Number 1 or number 2?
Okay, so we see. Okay, because this is all average. We are using all average. Okay, this is also average, right? But this is also an average, right? Because we divide by 2 here, right? This is we divide by number of
NFM, yes.
So let's find it. Okay, let's find it in the but before that, to use interpolation, your interest differential must not
Less
more
than
than 1%. Okay, so you have to find it 1%. Then only you can calculate the YTM. Because the
precise.
bigger the deviation between interest rates of, meaning that if you take the gap here 8 to 9, then it is quite difficult for you to find an nearest point for interest there. Okay, so meaning that you when you want to find the YTM, it will not accurate because the deviation will be much bigger. Okay, so you try to make sure that the interest deviation, the different of interest is 1%. So meaning that if you take 8%, then the next is you take 9%. Okay, just 1% interest differential. Okay, so let's have a look with financial calculator here. Okay. So in financial calculator, right? In financial calculator, if I put it, it's 81,000 and the year is 5. Okay, so the price is 970, right? So the YTM is 8.77. So meaning that, okay, and when I use this interpolation, right? This interpolation may bring you to the nearest point. The nearest point of YTM or the nearest rate. Okay, all right. So because this one, right? So you are actually calculating by 2% here. But what here is that you are looking at the value here. You are looking at the value here. So that's why some of the guru they prefer you to calculate this on the interpolation. Okay, so for you to make an assumption before which rate you want to try. Okay, for instance, now you don't know which rate you want to try. Okay, so what you do first is that you do the first one. Okay, you do the first one. So meaning that if this rate is 8.73, meaning that what you're gonna try is actually between 8 to 9%. Okay, so the first formula is actually right will direct you to choose which rate to try because interpolation is about trying and error. It's about trying and error. So now you want to do a try and error, so you don't know which rate you want to try. So when you use the first formula, so you have an idea which rate that you're going to try. Okay, which rate you're going to try. Okay, let's have a look at another assumption, another example. Okay, so so I'm gonna keep this, right? So I'm gonna have another one more here, the blank one. Okay, so let's have the same rate. Okay, the same bond, and it's 5. Coupon rate is still 8%. All right, coupon rate is 8%, and okay, 8%, and YTM you don't know. Okay, so now you want to find the price. The price of bond is, for instance, one. Okay, 1020. Okay, 1020. Okay, so let's try the first one. YTM formula where you are talking about the coupon payment divided by M, right? Plus the par value, right? The par value minus market value, par value. This one divide by par value N times M. Okay, so divide by, right? Divide by P par value minus market value divided by 2. Okay, so what is the answer now? Can you find this? So this one, coupon payment is 80, right? 80 divided by 1, this is annually, plus 1,000, minus 1020, this is negative, kan? So divide by 5 times 1, divide by 1,000. Sorry, this par value is plus, right? This is plus. Okay, this is plus. This is plus. 1,000 plus 1020 divided by 2. Okay, so what is the range here?
.075, is it?
7.5%.
7.5%.
Okay, so you will get 0.075. So you know from this calculation, right? It is between 8 to 7 to 8%. 7% to 8%. Okay, so if it is 7%, right? And this is the rate, right? So this is the rate of 1020. 8% is 1,000. Okay, so try 7%. Try 7%. So if YTM is 7%, so what is the price? So is it 1041? Is it 1041? Oh my. Correct?
Yes, Doctor, we calculated previously, yes.
1041. Correct. Okay. So now, second one. Second formula, YTM equal to lower rate plus lower rate value minus desired rate value. Okay. Lower rate value minus higher rate value times this one, 1%, right? So what is the higher rate minus lower rate? Okay, so this one is, what is the lowest rate? Is 0.07, right? 0.07 plus, so what is the lower rate? Lower rate is
120.
Okay, minus
141.
desired value 1020 divide by 1041 minus 1000, right? This is higher rate, right? Times 0.01. So what is the rate?
7512. It's almost the same. 0.07512.
0.075.
12. Yes, same, Becky. Almost same.
Same. All right. So 7.5. So
Percent.
this is 5 something, right?
Yes.
5.1.
Also, the beginning one also, the first one also what was
Okay.
5
So
something.
meaning that you will get the same value. Okay. So in your answer, you can use either this formula or you can use this formula. Okay. Either way you can use in order to answer the question. Okay. So this is how to find the YTM. Okay, so how to find YTM is crucial because you can't solve any equation when you have two unknown character
The rest.
in your formula, because when you do the calculation, right, here, right, so you have this unknown character here, right? This unknown, right? So the computer also can unable to identify because they quite difficult. I mean, not difficult. It is impossible. If you put it in the system, if you put it in the computer, so the computer will put it as error. It will put it as error. Okay, so let's look at the application of this. Okay, so what I'm going to do is that I'm going to stop sharing this, right? I'm going to stop sharing this. Okay, so I hope you understand how to find the YTM just now. Okay, so let's have a look at what is the use of this, right? Okay, I'm going to show you the share the screen. All right, so page down. Okay. Okay, what is right? So go here and right. Okay, so I have this. I have this few information on bond, and I want you to test. I want you to test on the calculation. Okay, on the calculation of this. Wait, okay. So this one. So this is this one. I want you to test, right? So for instance, let me have this in can I print this? Okay, I print and then I put it as save as PDF. See everything. So this is you are section 50. Okay, so making 3. Let's just put it here. Okay, bond price. Okay, okay, so I'm going to open this and try to do the calculation. Okay, let's have a look. That's one. Okay, can you see this? Okay, you can see this, right? Okay. Okay. Let's enlarge this. Okay, enlarge this. Okay, so this is the MTS, Government, Malaysian Government Security. So let's have a look with this item. Okay, so this is the remaining tenure. So this is the N. This is the N. Okay, so this is the coupon rate, right? This is the coupon rate. Okay, and so what else that you want to know? Okay, so you have
Interest.
N. So this is par value. Okay, par value, if this is the price, then the par value will be is 100. Okay, so can you try this out? Okay, so coupon rate is 3.90. So meaning that coupon payment is 3.90, right? Okay, so what is the N? N equal to, right? N equal to 2362 divide by 365. Okay, 2362, right? 2362 divided by 365, right? So it is 6.47, if I'm not mistaken, right? So I think this is 6.47. 6.47. Okay, so what is the price here? Okay, can you find the price here? Oh, I'm going to use this calculator. So what is the coupon? 3.9. Okay, 100. Okay, and is 2362 divide by 3 divided by 365. Okay, 6147.
0.47.
Okay, so what is the YTM? So YTM is 2.86. YTM is 2.86%. Okay, 2.86%. Right, so what is the price here? Right, you will get the price 106.07. Okay, so 07 or 05, because I'm taking the whole number. I got 106.07. But here it's stated is 106.07, 05, right? So this is the price lah. So this is the price. Or this is the value of the debt, or value of the bond. So don't worry about the terminology, because either you use the price or you use the value is the same. Yes. Okay, did you get the number here? Did you get 105 here? Okay, so this is 105. All right. So let's enlarge here. Okay, so this is 106.05. So when I calculated 106.07, okay, so this is like if you, because I take the whole number lah, the whole number. Okay, so this is the price lah. So what is the price? This is the price until 5 today, until today. This is the price for today. This is the price for today. Okay, so let's test another one more. Okay, let's test another one more. Okay, by looking at another bond, right? Another bond. So let's have a look at here. This is a short term. This is a short term national government security. So let's have a look at another one more. Okay. My session has expired. Okay, never mind, never mind. Okay, so we go to because this bond, I have a problem just now when calculating this bonds, Oh, restart. Okay, market activity, okay, trading activities. Okay, so this is for today tau. And this is for today tau. Okay, so let's have a look at another one more. Okay, so code stock. Okay, so let's have a look here. So what is the price here? This is the 3.89. Okay, let's have a look now. Okay, so let's try this. This is another MGS, government security, right? So this is the remaining. Is it the same one? Is this the same one? 3.9.
This, yeah, it
The
looks
same
like
one,
the
right?
same one. Yes, yes.
The same one. Okay. So we take another one, another one. So we take another one. So meaning that this was traded, traded in the market. Okay. So the top one, Islamic midterm notes. Let's do another one. Okay, and let's try this 2024 tranche 6. Okay, let's have a look here. Okay, so this is the one. Okay, when is the maturity date? 2024. When is issue date? 2021. So this is a midterm lah. This is a midterm, midterm. Okay, can you calculate this? So this is the coupon rate. So this is the coupon rate. So this is the number of day, right? And this is the yield. Okay. So let's try this. Okay. So 100. So what is the coupon payment? 5.4. Okay. And N is 1080 divided by 365. I want you guys to try, because if not, then you won't have a picture of this bond valuation. Okay, because you are looking at the current market price of the bond now. Okay, this is 5. So here 2.96. So the M. And so what is the yield is 3.03. Okay, so I got the same, I got almost the same answer. 106.30.
What is the coupon payment? Which one? This 5?
This is a coupon rate. How to find coupon payment? Coupon rate times our value.
Coupon rate multiplied by our value. Huh?
Multiply. 106. So, okay, for this, okay, so shall I print this? Okay. And two. Right there. I'm just trying another option. Save a PDF. Okay, so this is what I'm gonna do. Okay, so I'm gonna save it as a price 2. Okay, so I'm gonna open this. Let's have a look. Okay. Okay, I want you to try because this is an application, Islamic medium term notes. So this is also a debt security. So this is the rating. People double A2. Double A2. This is the rating. The current rating is
A3.
double A 3. So This is the name, instrument name. All right. So this is the, okay. So the stock description, normally this stock description, what they have is that they have this coupon rate, and then they have this maturity. This is maturity, maturity. So this is the coupon rate. Okay. So this is a coupon rate. So what is the coupon payment? Coupon payment is 100 times 5.40%. So coupon payment is 5.40. So what is the number of days? 1021 remaining tenure, yeah? So N equal to 1021 divided by 365, right? And your yield to maturity is
Why we look at
3.
the remaining, not the issue tenure?
Of course, you cannot take the issue tenure, okay? Because you want to see what is the remaining. Because, okay, good question. Because you want to hold to until maturity, right? So this is the maturity, maturity. So therefore, okay, so let's see, okay, you purchase this here. You purchase, purchase. This one is the issue. So when is your holding? From here to here, right?
The end,
From
yes.
here.
Yes.
So this is not your holding. So this is not
Yeah.
included. Right? Very good question. Because at least when you ask, then I can explain this, right? So to calculate the value, you have to start from here, not from here. Because this is the time where you want to invest.
Buy the bond. Yes.
Yeah, you want to buy or you want to invest in bond, right? Okay. So here, right? So here you can do is, so 5.40 again, if you want to use the formula. So the price here is 5.0 times 1 minus 1.0303 power of, this is the one. Okay, so 1021, okay, 1021 divided by 365 equal to
0.79.
2.7, 2.8 lah, 2.8 lah.
2.8, yes.
Okay, it's 2.8. Okay, so negative 2.8. Okay, can you see this? Negative 2.8.
Yes.
Negative 2.8
Yes.
divided by 0.0303, okay, plus 100 divided by 1.0303 power of 2.8. Okay, so I think I need to change the color, right? I change the color here to let's say I just into it. Okay, so let's delete this. Yes, I want to change color. I want to change color because I want to see. I want you to see. I want you to see the calculation. Okay.
Doctor,
So
excuse me, doctor.
the P0 equal to 5.40 is the coupon, right? 1 minus 1.0303 power of negative 2.8, right? Divide by 0.0303. Okay, 03 plus 100,000, 1.0303 power of 2.8. So
But this 100,000, we bring it from where?
100,000 is the par value. Okay, so if the price here is in the range of 100, so meaning that the par value is 100. The par value is 100. Okay, so what is the price here?
estimation? This is estimation. This is estimation. We supposed to estimate.
No. Actually, if the par value is 100 or 1,000. Okay, so if the par value is 1,000, the price cannot be 106,
It will
right?
be
Because
1,000 something.
because if the par value 100, then it will range between 100 something.
But
Eh?
this is only for Malaysian market or internationally they are using this?
I'm not that really sure on the international market, but now we are actually using 100 ringgit as well. I think US also using the 100 ringgit. Eh? All right. So, okay, shall I continue? Okay, so what is the value here? Okay, the value should be, right? Okay, 3.03 is the one, I is 2.8 is the N, 5.40 is the payment, 100 is the par. So you will get 106.27, or this is near to this price lah. Okay, if you didn't truncate the value here, right? Because you're gonna have this 1.0303 power of 2 point something, right? Because this is actually 2.77 something, so we only take 2.8, right? So if you do that, okay, you will get the same answer as here. Right? So this is the application of the bond valuation. Right? You can see the price is moving, right? It's towards this, right? Okay. Any question? Any question?
Doctor, I want to ask
Yes.
something
Yes.
regarding the par value just now.
Yes.
Is it between the 100 and 1,000 based on the prices on the firm?
Yeah. We look the
Oh.
indicator of the price here.
Okay.
We look the indicator
So
of
if
the price. So if the price
at
is the range
100,
of 100, pardon?
if the price is near to 100, then we put the par at 100. If the
Exactly.
price is near to 1,000, then we put 1,000.
1,000, exactly. It is between 100 and 1,000 only. That's two options. Okay. So in the question, normally in book, we give you what is the par value. So in here, we assume lah. We assume it is 100. Okay. If you put par value is 1,000, right? So okay. So what if you put the par value is 1,000? Okay. So if I put the par value is 1,000, right? So
Get 1,000 something
for
price.
your payment, or your coupon payment, your coupon payment will be 54 ringgit, correct? 54 ringgit. So, right, 3.03 is the interest, right? The price will be 1062.73. So if you put par equal to 1,000, if par equal to 1,000, the price will be 1062.72, which is violating lah, incorrect lah. So this is actually the par value is 100. Okay. So the weaknesses here is that because they know they actually in this website they assume that you know whether this is 100 or 1,000. Okay, so definitely when we try 1,000, right, we cannot get the answer of the price, right? We cannot get this price. This price. We cannot get this price. So therefore, the par is
this
100.
website like exchange, like where you buy this bond and stuff. It's like
Pardon?
Bursa Malaysia. This
Yeah.
website.
You actually okay. So actually this price is this trading is actually available in the market lah. Okay, but what happened is that because the bond market is not that really volatile and the transaction for bond is not heavily traded by, we call it as our local investors. Okay, so normally the bond is traded by the corporation. Okay, because they want a steady income. Okay, what you do normally the petty investor like us. Okay, so normally we use to buy bond through a mutual fund. Okay, so through a mutual fund. So meaning that we don't directly trade the bond, but what we do is that we buy a mutual fund who is traded in the bond market. Okay, so in mutual fund, they have this what we call as a fixed or income fund, or they also can name it as a bond fund. So meaning that a large portion of the money is invested in bond. So why in bond? Because bond give you a steady income. Why steady income? Because of this coupon. This coupon is a steady income, meaning that you will receive regardless of what, regardless
going
of
on.
what is the economic situation of the country, you will receive this coupon payment. It is a must. The company
It's not
has to
depend
pay,
on dividends.
the coupon payment. So that's why we call it as a steady income, steady income or income fund. So normally the petty investor like us, right? We will trade in mutual fund for bond, okay? But we can also buy a suku, suku offered by government, Malaysian government to public. You can buy this to an investment company or investment bank. When they offer this suku, they will open to public. So you can do that, okay? Because the investment in bond, you need a lot of money. Okay, so if bond value, last time the par value is 1,000 worldwide, and worldwide the par value is 1,000. Meaning that if you want to buy one unit is 1,000. Okay, compared to the common stock where one unit it could be one ringgit, 2 ringgit. So if you want to buy like one lot, okay, one lot of common stock now is 100 unit. Okay, last time one lot is 1,000 unit. Okay, so they reduce it. They reduce it because they want to attract all these petty investor. The petty investor is actually a investor like us lah. Investor like us. Okay, so if you want to invest in this bond, right? So you can call your remiser, saying that are you interested in invest in bond market. Okay, so they will ask you how much money you want to spend on it. Okay, they will look into the market and then they will try to do the analysis and they will try to advise you on which security that they will benefit for you to invest in. Okay, so this is the duty of the remiser. Okay, so there is another one more thing that I want you to I want you to know.
Doctor, I have another question. Sorry, before you
Yes,
continue.
yes, yes, Tariq.
Now, what I'm trying to understand that now in this report there is nothing mentioned about who's selling this bond to me, right?
Okay, so so you may find this in the what you call it as the issuer lah, the issuer. Wait, maybe I can share with you who is the issuer, right? Before here.
Tanji bin Energy SDN Berhad.
Pardon?
It's down there mentioned
Yeah, issuer is a Tanjung Ben Energy, all right? But you want to know about this Tanjung Energy, you may go to the you may go to this Tanjung Ben Energy, go and search for this lah. Okay. So this is Tanjung Energy Johor. All right, Johor. So you may look like into that, all right? So these are the issuer. So who is the arranger? So is investment bank. Okay. So normally investment RHB investment bank will offer to their investor. Okay. For instance, like Citibank previously when I was working with Citibank, we have all these we call it as the wealth management. Department where we actually we handle all these we call it the high-end investor. Okay, so high-end investor. So we have an investment manager. Okay, this investment manager will have a certain number of clients, right? So when we have all this offering like suku, okay, like commercial paper, for instance, like we have like hybrids, we call it as the market link investment MLI. We call it last time. We have this market link investment where we actually we invest the money in a different industry in a different country or whatsoever. So we open this to this investor. Okay, so for you to be this kind of investor, either you are the platinum, gold member, or whatnot, you have to have a certain value of wealth that we actually we can you can appoint you the investment manager. Okay, so this investment manager, what they did is that, okay, so you know that your client wanted to save the money, to invest the money. So I said, okay, I have this 500,000 where I want to invest this money. Okay, so it will give you a few alternatives. Then you may choose lah, one of it. Okay, so either it is in a mutual fund, okay, market link investment, or maybe you want to have a suku investment. So we also have a suku investment last time. So because when it's open to public, when it's open to public, we'll have a suku. And then there's a few security that we're offering to the investor. So meaning that you have to be a special client in order to experience or to benefit from all this kind of investment managers consultancy. Okay. In a way that you have to be rich lah. You have to have a money in order for this investment manager to entertain you. Entertain you. All right. So or sometimes we call it as a relationship manager. Relationship manager. So this relationship manager will be able to advise you on what are the securities to invest. Okay. So any question on this one? Okay. Anything? Yeah, see this on the market today, right? So I think maybe I have something here. Maybe let's have a look. Okay, so this is on. Okay, so this is the benchmarking. Okay, mark. This is mark. This is RAM. Okay. And this is another one. Okay, so this is actually on the same one. Okay. And so this is the bond. Okay, so this is the investment in bond. Okay, let's see here. Okay, so what is the bond market today? So bond market today, bond. Okay, let's see MGS. Let's see the bond indices here. Okay, bond indices. Okay, look at Malaysia market. Okay, so all the
Middle East.
markets. Look at Malaysia here. Can you see here? Can you see the screen?
Yes.
Okay.
Yes, we
So
can see
let's
that.
find where is worldwide. Right. Let's see where is Malaysia. HIJKM Canada. All countries. Okay. I can't see Malaysia.
Go to Asia Pacific, Doctor.
Asia
The
Pacific.
left side. Yeah.
Oh, okay, yes. Okay, Asia Pacific, Asia Pacific. No, we are not here. All Asia.
What does it mean, maturity overnight? Next day directly or what?
This is Shanghai. Wait, we are not on the Asia Pacific because we are European, American, worldwide. Let's see the worldwide first. Ada tak ada Malaysia ni? Malaysia, see the nation here. Okay, just all countries, search. Let's search, go on. And FTSE, Kuala Lumpur. It's a Kuala Lumpur. Yeah, it is here. Okay, market, bond, indices, okay. In bond indices, yeah, Middle East, Australia, worldwide, worldwide. FTSE, okay. Can you see KL here somewhere? cash value is double that. I am looking at the flag. Okay. So let's go to work in this. It should be here somewhere. It should be here somewhere. Okay, let's go in stock. Okay, stocks. Bila cari tak jumpa kan? Itulah dia.
Go to world government bond, Doctor.
Okay, try lah. Try. Okay, world
On the market.
world
On the
government bond. Could be lah. Okay, world government indices. Okay. Market. Bond. World government bond lah. Okay lah. So we go for here lah. So let's go here. I think you can find it here. You can find it here. This is more. Okay, so Malaysia. So let's find Malaysia here.
Yes. Here it's here.
Up.
Up a little
Alright.
bit.
Yes.
Afterwards.
Okay, so maturity. Let's have a 10 years maturity lah. Okay. Government bond. Okay. So you can have this. Okay, Malaysian 10 years. Okay, so these are the Malaysian lah. So this is only government bond. Okay. So Malaysian 10 years bond. Okay, we can see that the yield is 3.229. Okay, traded today. Traded today is 3.229. Okay. So these are the prices here. Previous close, right? So coupon 2.63. So what is the previous? So price open. So this is the price. This is the price. This is the coupon. Okay, so this is maturity date. Okay, so they don't have the you cannot calculate here lah because you don't have the maturity or the remaining tenure, the remaining tenure, right? So this is only the prices lah. This is only the prices. You can see that the bond market is actually overwhelming lah a little bit because our interest rate is low. Our interest rate is low. So that's why when you invest in bond, right? When you invest in bond, so you have a steady income. You have a steady income. All right. Okay. So I'm so sorry because I couldn't get those those prices for that. Okay. So maybe okay, let's see. Because although that we have already here, right? So why don't we just check on the stocks winner? Okay. So let's find the Malaysian here. Okay, what is our index here in Malaysia now? Malaysia. Okay, so these are the stocks. So these are the stocks here. So looks like everything is positive, right? So what is it? Is it increasing today?
Where are you looking, doctor, so we can learn? What is that?
Yeah, I keep on looking, right? Okay, so this is on the common stock. This is a stock. This is a
Yes.
stock. All right. So did you notice here that here the prices, the change here is almost positive. Everything is almost
Positive.
positive. We have a few
Okay.
negative here, Petronas. So you can see the Petronas chemical is down here, down. All right. So when we look into our indices, right? So this is the stock in Malaysia, right? So I assume, okay, let's see the price. The okay, this is the popular stock. KL, Kuala Lumpur. This is the blue chip. This is the blue chip company. This is the blue chip company, the blue chip stocks, right? So this is the blue chip stock. So we will learn how to calculate this. This is the common stock valuation. All right. So let's go on the indices. So how is it our Malaysia is doing? So indices here. Okay, so Major indices, right? Major indices. Let's see our index today. Let's see our index today. So Malaysia mana? And they asked me to pay lah in order for me to experience the we'll call it as the non apa advertisement lah. Tak ada advertisement. Okay. So so what is this? 3,000. Let's find Malaysia.
There is one Saudi Pakistani company
You
in
want to?
China. No, I was
China.
looking at the flags.
The flag, yeah, I'm looking at the flag now. Okay.
This is Malaysia or
Yeah lah, I'm looking for Malaysia lah, this one, right? Indices, major indices, world indices. Okay, let's see world indices here. Okay, let's see world indices here. Okay, so all countries. Let's find Malaysia. JKM, Malaysia.
here?
Okay. Okay. Malaysia indices, right? Okay. KLCI. Appreciate. Okay, so meaning that if you are actually invest in the index mutual fund, so meaning that you are actually your NAV will be appreciate lah. But you see the FTSE 60, mid 60. Okay, you can click here to see what are the stocks in here lah. So we are actually at a major downfall on this three market here because the top 100 is negative, right? Although that our KLCI is positive here, okay, what happened is that because they have 100 component here, in the KLCI, okay, let's go here, let's go here, KLCI, we only take only a few stocks, a few stocks, right? So what are the stocks here? Right? So what are the indices, right? So okay, they don't actually what is the component? What is the component? Okay. Okay, so these are the component. Okay, so these are the component. So I think this is like 30 stock. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10, 11, 12. Okay, I think it's 30. 30. 30. So this is a component for KLCI. Okay, but when we look into here, it's also have a red here, red color here, meaning there is a it's reduced. I mean the is the falling in the price of the stock. Okay. So when we are looking at the KL FTSE, 100 here. Okay, 100. Malaysia top 100. Okay, Malaysia top 100 is falling. It's falling because the stock here at top 100 is all the blue chip stock lah. Blue chip stocks is actually, let's see the component. The component for it. Okay, the general. Okay, so these are the stocks. So 100 stock. Buy. Oh, so it is actually a buy sentiment, meaning that moving average, buy meaning that it advise you to buy. It advise you to buy. So meaning that when the price is falling, so it is a good time for you to buy the stock. Okay, so let's see the component here. The component must be is more than this is 100 stock lah. In the market. In the not in market, in the circulation. Okay, so I don't see the component here. Did you see the component here? Chart, technical, forum. Okay. No, I don't see the component here because I want to see what are the stocks here. I know what are the stocks here. So I don't see it here. So okay, I don't see it here because we wanted to see what are the component for this 100. For this top 100. Top 100. So this
top
is
100 is a fixed menu,
I
fixed
can't hear
list
you.
or
Tarik.
changing? This
can't
top
hear you.
100. This
Pardon?
top 100, Mali. Top
Yeah,
100
top-
list.
top 100 stocks.
Is it fixed one or it is changing each time?
Active lah, blue chip. Blue chip. The volume, we can see. I can see the portfolio. Okay. So I didn't see the component here. I don't see the component here. But when I look into that KLCI, I can see the component. Okay, so ACE, ACE. Let's see the ACE.
So you mean, doctor, the list will be revised every day or yearly, or how? The 100
Yes, it will
companies.
revise. Okay, so here also I don't have the list of the stock. Okay. Okay, so I don't see the stock here, but only I can see the number of stocks that is in KLCI. So in the index, KLCI index. Okay, so this is actually on how to trade lah. So if you want to trade, so you go to investing.com, then you can start trading lah. Start trading here. You can start trading. Okay, so I haven't start trading yet. Okay, so I don't have that much fun to start trading. Inshallah, if I have one, then inshallah, I will try to do that lah. Okay, so oh my God, it's already 7 o'clock. Okay, I thought I can have time to discuss on the valuation, the stock valuation. Okay, but I already show you how the market is actually trading, traded. Okay, so any question before we stop on this today's lecture? Okay, so next class, what we're going to do is that we have to check it because we need to finish all this syllabus before we go for the case analysis. Yeah, so you have to know the basic concept of finance in order to find the valuation, the time value of money. Okay, because if you claim that you have finance courses in your MBA, right? But they are when they ask you how to value bond, value common stock, you cannot do that. So it's no point. You are in the program. Okay, so meaning that you cannot claim anything. Okay, because later what we're going to do is that from this understanding of the concept of finance, then we will lead into the issue which is related to finance. Okay, so we need to finish all this theory first. We need to finish all this theory first, then only we move to the case analysis. So you're gonna have 2 slots of case analysis, right? And this case analysis is actually on the current case. Current case, then you will discuss this matter. You have this issue, you will try to interpret what is happening in the organization, what is violating the rules and whatnot. Okay, so any question before I complete this lecture?
Actually, doctor, for the 10 years
I can see
company,
that some of you guys are staring at me like you want to eat me, Okay, someone
doctor,
is like looking at me like this one, So I know it's already 7 o'clock, so don't tell me that. So everybody is exhausting now, right? Okay. So any question?
doctor, I have one.
Tariq, yes.
Side.
Tariq, how come I couldn't hear you
Side here.
properly?
Side here.
Said is talking. Not me.
Okay, Syed.
Yeah.
Okay, Syed.
About the company that we choose for 10 years financial statement, what we are going to do with that company? Is there any further instruction?
Okay, that will be in your FEEP, Final Exam Equivalent Project.
Should we copy all the records to Excel or just keep it as it is?
What?
Should we copy the records from this financial report to an Excel
Yes,
sheet?
of course. You have to download. You have to download because you need to evaluate, you need to analyze on this company. You have to write a report, especially on the financial performance of the company. You have to do that, and we are actually finalizing the FEEP question. So you have to answer a few questions pertaining to the company that you have selected. Okay, and you have to do a forecasting. You also have to do a forecasting for that.
Podcast.
Forecast. So what forecast is that you have to forecast on the cash flow lah,
Profitability.
cash flow of the company.
Cash flow.
All right. Okay. So your competition. Okay. So section 50. Section 50. Section 50 FM.
26.
What 26?
We choose the date 26, right? June.
Section 50,
Huh.
MBSA 50. Section 50. Yeah, I have a few. Okay, wait, I have a few here. Which one is yours? 50. Okay, is it the one? Finance. No. Financial management. Is this the one? Okay, so your capsim will be on the 26th of June. So have you have given me the list of the group, right? Okay, all right, okay, so 26, 26 confirm, Okay, so that's it, 26th of June, 26th of June will be your competition. Okay, all right, I will change that in your e-learning. Okay, so let's have a look here, like so share the screen. I want to go for this one. Okay. All right. So this one is section 50. This one section 50. Section 50. So let's have a look at the capsim here. Capsim competition. Capsim simulation. 26th of June. Oh, so this has been shared to you. All right. Okay. So done. All right. So your competition is done. So anything before we go? Can you share the QR code again? Okay. Wait, yeah. The QR code, QR code, QR code. Okay, beside QR code, anything? Is this the one? This is section 50. All right. So this is the QR code. Okay, anything? Yeah, Sharon?
Nothing, Doctor.
You accidentally press the button. Okay, so if there is no, right? So if it is nothing, adjourn this meeting until the next, when is our next meeting? In June, right? Next week, right? Next week, okay? So what we're going to do on the next week is actually we want to look into the valuation of common stock. Valuation of common stock. Okay, so the valuation of common stock, it's difficult to have a look at the market trending or the market prices, okay? Because the valuation of the bond prices is actually not only on the technical valuation. Okay, for bond is a technical valuation because we look at the YTM and whatnot. Okay, but for common stock, we have all the sentiment and speculation. All right. So what we're going to look at is that we want to look at the intrinsic value of the common stock, and then we want to compare with the market price, whether it is underpricing or overpricing. Okay. So we're going to look at that. Okay. So hopefully in 2 hours I will be able to complete like 2 chapters next week. Okay. Because we are actually behind time. So this is your third meeting. And suppose by this third meeting, you have already completed the common stock valuation. Okay. So I will share this video with you guys. Okay. For those who have not able to attend to this class, so you will be able to revisit the video. Okay. If you miss me for this coming 2 weeks, right? So you can open the video anytime. All right. Okay. So then, bye.
Okay,
Bye. Thank you,
Thank
Doctor.
you, Doctor.
Yeah. Good night.
Thank you.
Thank you, Sonia.